Welcome to The Explainer. Today, we are digging into a really fierce debate that's been kicked off by a new government report. And it asks a pretty provocative question. What is the real economic price tag of the nation's top financial watchdog? Okay, let's just dive right in with the number at the absolute center of it all. $369 billion. That is the high-end estimate of the total cost that a new White House report claims the Consumer Financial Protection Bureau, or the CFPB, has imposed on all of us Americans. So this truly staggering figure, it comes from a report by the Council of Economic Advisors, the CEA. And their argument is basically this. Since 2011, the CFPB's rules have cost consumers hundreds of billions of dollars. And that, they say, far, far exceeds any money the agency claims to have returned to people.
So you have to be asking, how in the world do you get to a number that big? I mean, where does that even come from? Well, the CEA's calculation is actually built from several different pieces. So let's break it down.
Now, what's really interesting here is that the lion's share of this estimated cost, pretty much the whole shebang, it comes from one place. This idea of higher interest rates on our mortgages, our auto loans, and our credit cards. The other stuff, like paperwork and fiscal costs, they make up a much, much smaller slice of the pie. At the very heart of this whole debate is one specific regulation. It's called the Ability-to-Repay rule. Now, you might remember this was designed right after the 2008 financial crisis, and the whole point was to stop lenders from handing out mortgages to people who, clearly couldn't afford to pay them back. The CEA report really zeroes in on this. It points out that loans that are objectively riskier, we're talking about those where a borrower's debt is over 43% of their income, now come with higher interest rates. And the report's argument is that this price hike is a direct cost, a direct result of that regulation. But is that really the whole story? Well, almost as soon as this report hit the streets, economists and legal experts, they started poking holes in it. They began to question not just the math, but the fundamental assumptions it was built on. And this brings us to the absolute crucial question here. Are these higher rates a regulatory distortion, like the CEA is claiming? Or are they just a more accurate reflection of the actual risk involved in giving someone a loan? And this perfectly illustrates the two totally opposite ways of looking at this. The CEA sees an unnecessary cost that's been forced on the market by a rule. But the critics, they see the market finally pricing risk correctly. Something that wasn't really happening in the run-up to the 2008 crisis. Critics also point to what they say is a huge piece of the puzzle that's just missing. Professor Adam Levitin from Georgetown, he points out that the report completely ignores a key directive that stopped government-backed firms from even buying these riskier mortgages. And that's a major factor that has nothing to do with the CFPB. So to kind of wrap up the criticisms, the report is being accused of blaming the CFPB for what might just be the market getting smarter about risk. It also potentially uses some fuzzy math, and it totally ignores other major government actions that were hitting the exact same mortgage market at the same time. Okay, so let's peel back the next layer of this debate, because it's not just about the numbers themselves, it's about what those numbers actually mean. All right, stick with me here, because this is a really key concept in economics. There's a massive difference between a transfer and a cost. Most of that huge $369 billion figure, it's what's called a transfer. A borrower pays more to a lender, money just moves from one pocket to another. The actual economic loss, what economists call deadweight loss, is estimated by the CEA to be much, much, much smaller. In fact, if you look inside the report itself, their own estimate for that true economic loss, the value that's actually destroyed, is only up to about $5.7 billion. That is just a tiny fraction of that big headline number. And putting it in context like this is so important. The CEA's huge headline number, that $369 billion, it's being compared against the $21 billion the CFPB says it's returned to consumers. But really, maybe the apples-to-apples comparison should be with that much, much smaller deadweight loss figure. And this brings us to what critics are calling the report's biggest blind spot, the entire other side of the equation. What about the benefits of this regulation? So here's the crucial point. The report goes to great lengths to try and quantify potential costs, but it doesn't even really attempt to quantify the potential benefits, things like deterring bad behavior, or maybe most importantly, helping to prevent another multi-trillion-dollar financial meltdown. And all of this, it leads us right to the fundamental debate that's really at the heart of this whole issue, and it's one that goes way beyond just a single report. Ultimately, what you've got here are two completely different ways of looking at the world.
One view meticulously calculates every visible cost of having rules. The other points to the invisible but potentially massive benefits of preventing a total disaster.
And that leaves us with a final and really challenging question. Think about it. It's easy to count the cost of a safety measure, right? But how in the world do you calculate the value of a crisis that didn't happen? What you should take away from this is that measuring a regulator's true impact, well, it's a whole lot more complex than just one single headline-grabbing number.